Well, hello everyone, and yet again to welcome to another episode of our new Vesto Show, so to say, the Vesto Show, which is more or less a regular ramble between Sean Stapley from Penrose and me. Sean, first of all, welcome back. I'm glad you didn't leave running, after the first show with me. Glad you're still around.
Pleasure to be back, Carsten. Thanks for having me.
Wonderful. Always enjoyable to discuss what's happening all around the world of crypto, and well, obviously it's interesting days at this point of time. We've long been discussing about the crypto winter, and it seems like at least we can put away the super thick sweaters again. It looks like we're moving towards spring a little bit, either going up by 10% last couple of days, Bitcoin being above 22,000 again, so things are moving. But the bigger thing, which is sort of hitting everyone at this point of time, not just crypto lovers, what's hitting every household at the moment, obviously, is the big inflation thing, and that's happening in Europe, that's happening in the US, that's happening all over the world, based on many reasons, based on energy prices, based on the global sourcing and logistics. And, it's kind of like an inflation we cannot escape at this point of time. It hits the most basic areas of our daily life, our energy, with winter coming up and everything. So Sean, what I'm hearing quite often, these days is, crypto can be such great hedge, against inflation. What do you think about that? Is crypto a hedge? And of course, from a Vesto perspective, especially, what's the role of DeFi in that hedging situation? Any thoughts on your end?
Plenty. So I think to kick things off, I think the inflation hedge argument gets twisted a few times. And one of the big arguments against for me, Bitcoin being this inflation hedge, this idea that, essentially we are, now sitting in a position where if you just held from, the top of 2017, you're still basically only just up above it in 3-4 years, right? Inflation has skyrocketed, but Bitcoin has not and stayed up. And so I think one of the key facets to remember is that although it can be said that Bitcoin may be an inflation hedge in some way, Bitcoin is much more of a hedge against governmental control, right? It's a hedge against the money printing. It's a hedge against the centralized monetary system. The unfortunate reality of that, however, is also that when people have cash debts to pay, they're going to sell off something that is much more liquid. Bitcoin is exceptionally liquid. It's very easy at a moment's notice to liquidate anyone's holdings and to be able to quickly, shift away and then transact out and to pay your debts. So I think one is that we saw a lot of that in the last 5-6 months now. People had debts in the real world, and of course, Bitcoin is a nice lucrative asset to hold long term. But it's not necessarily a get rich quick overnight. It's a safe haven asset, and I think that's the important distinction we want to make. So I think when we look at things like seeing the inflation spike around the world, one of the key pieces that we're keeping a close eye on really is how do you necessarily hedge your bets in without getting caught up in the noise? And I think to that extent, that's why, as we chatted a little bit offline last week, but the discussion around things like Celsius and the insane interest rates that they were able to offer, right? It comes out now that a lot of what Celsius was doing was in fact just a large scale Ponzi. And the gentleman behind it, Jason Stone, had put out essentially saying, look, we were running this assuming that Celsius was taking basic risk operations seriously. Turns out they weren't. They had, as per Jason, naked exposure to the market. And so when you see this and you begin then having a bit of the public perception is that, oh, well, maybe the interest rates being high there were just all a scam. Where else do I put my money? How do I avoid losing it? I think those are some of the big worries, is that as we saw with the collapse of both Celsius and with the Anchor protocol from Terra, which was able to offer 20% interest on stablecoins, people are now concerned, right? All of MSNBC is saying, here's our top FANG picks, and here's the tech stocks that are safe havens. And I think the reality is a lot of people don't know. A lot of people are not sure what is going on. So to that extent, I think it's we're coming up to a situation where rampant inflation is clearly here. Is it here to stay? Possibly. I'm not going to make a bet on how long that's around. But what I think is fair to say is the companies that will hold through this are going to be those that are actually bringing some innovation to the market. You can't just necessarily ramp the old system up into a crypto wrapper and then hope that it goes well. I think you do actually have to bring some real innovation to the space. So, inflation being a way that takes away from people's savings, I think that's where you do have ones like Bitcoin and other cryptos make a lot of sense, but also making sure, obviously, that you're necessarily potentially self-custodying or things like this as well. So that's just kind of general thoughts there. But I mean, I think the other part is going to be, how do we see, for example, stablecoins integrating into the system? And is that, for example, a different outlet or a valve away from kind of the monetary pressures we're seeing? We're not sure. I think it could be, but obviously the money printing itself, regardless across the board, is still going to impact stablecoins just because they're going to be potentially dollar pegged, euro pegged.
Right. And most probably, with the high level of debt on the governmental side, we'll see the printing machines running for, monetary bills, for dollar bills, for euro bills, for quite a while, which is not going to necessarily drive inflation down, even though it does not seem that this inflation right now is really money printing induced. It's more induced by specific factors, like energy cost, for example. No, but three big points, I'm taken out of your thoughts. First thought, which I find interesting also with regard to DeFi. I mean, last time we were discussing a lot at looking at crypto on a speculation side, the classic Bitcoin or other token speculation issue versus Bitcoin as the fuel, as the rails for, decentralized services, and or crypto, being the rails for decentralized services, and obviously then we're talking DeFi. Obviously, we're talking DeFi tokens. And remember, when we talked, this was when the winter was still in full swing, but we saw the DeFi yields, slowly moving up. And I see what you're saying as a potential danger as well, because on the one hand, we see DeFi yields developing nicely again, which is good, which is positive news. And hey, as long as the DeFi yields are above the rate of inflation, they are, of course, one hedging tool, which probably has a little less of a volatility than Bitcoin, either or other of those rather speculative tokens would have. On the other side, as you said, there's a lot of broken trust. If we look at what happened, we looked at Voyage Digital, we looked at Celsius, so there's a lot of players, which defaulted these days, so people are concerned, as you said, Celsius was essentially a Ponzi, and crypto is still so new that people, do not know the difference between, hey, what's happening here and what's happening in rather credible kind of DeFi yields, DeFi tokens. So that's one interesting one, which will soon bring me to Circle's behavior in recent days. Another issue which I saw, which is really interesting, is the matter of innovation. It's that the markets are looking for innovation, and that fintechs who simply, make the front end a little nicer and put some lipstick on the pig, so to say, they're not going to survive sustainably. They're not going to grow sustainably. And especially here in Europe, we're having this big discussion about Klarna, Klarna, which was a fintech that, we only knew as prospering over the past couple of years. And now their valuation has moved south incredibly. They've cut 2/3 of their employees, and that might be an interesting case of a fintech that was successful, by putting lipstick on the pig, making the front end look nicer, but didn't really have a serious innovation on the back end, didn't have anything to offer, along the process. But Sean, let's start talking about Circle. Circle really spending a lot of effort at the moment to reaffirm commitment to transparency, and there was a clear statement, and I'm quoting Jeremy Allaire right now, their chief technology officer. So many facing fundamental challenges and risks. Circle has amped up our information about Circle and USDC, so really looking at USDC, what's happening there, and what's Circle doing, and what's the impact on the market of, Circle, such a big player, moving that direction.
Mhm. Yeah, so I think a couple interesting points there. Number one would be when we look at firms like Klarna or USDC, really at the end of the day, what we're speaking about is how can I streamline transfer value, right? And so I think it's not surprising that we're going to see payment firms have seen a spike in valuations as payments were more easily flowing. We had a lot more money in the system. We had a lot more people that were able to spend more freely, both from the perspective of receiving stimulus checks, but also from the perspective of a huge amount of money was pumped in, and likely that has in some way trickled down. Not nearly as much as people will hope it will. But I think, when we look at ones like USDC, the stablecoin backed by Circle, I think part of it comes down again to understanding, are there actual innovations being provided here, or are we just putting, as you say, lipstick on a pig? For example, that's okay if all we're doing is making streamlined payments, but you have to then cement yourself in for the payment rails of the future, right? Circle launched their Euro stablecoin, I think maybe it was last month. So a lot of what we're seeing here now is, if you're more easily able to transact value, you increase the velocity of all of the money within the system, and as a result, you're going to increase GDP. Fantastic. That makes a lot of sense. We can keep ourselves hopefully a little bit out of the impending recession and find a way that we're going to actually end up maybe not necessarily coming out swinging, but definitely surviving throughout the course of what could be, a multi-year bear market. I think the other part with this is that, and very, very relevant in Vesto's situation, is also that if you have a way to have a more transparent market for yields, that's where something like a financial institution that may be, looking across a vast array of services are more open to being able to onboard themselves into something like a digital asset like stablecoins.
And that's interesting, because also recently published just a couple of days ago was an interesting study which looked at crypto friendliness of various countries and various markets. And what you are mentioning right now was exactly one of the main drivers that put Germany and the US on top of the two most crypto friendly markets. The fact that the big sort of traditional financial institutions like the savings bank Sparkasse in Germany, like Fidelity in the US, that they're accepting more and more crypto as a means of transaction. Switzerland on place number 3, also because you see Swiss regions, Swiss cantons right now, like for example, I think it is the Swiss canton of Lugano right now, which is pretty much accepting Bitcoin as a legal tender right now. You can pay your taxes, you can pay everything in crypto right now. So I think what you're mentioning is a real big point, also for us at Vesto, obviously providing rails for any kind of crypto peer-to-peer interaction, that there is this kind of acceptance by the big boys, despite the fact that they're coming from the old financial world. This is the trust builder sort of to the market and to a variety of market players to enter.
Well, I think that's the other piece, right? Is that when I think we're looking at kind of what are the innovations, what's going on, the big theme that we're keeping an eye on here is that transparency might be a good thing from the perspective of retail users, but I think it's also fair that institutions might be delicately approaching something that has full transparency, right? Even from the perspective of assuming everything stays well within the area of legal actions, which, we have seen banks not necessarily always tending towards that, but we have seen that transparency might not necessarily be in their best interest if you have things like proprietary trading strategies, or you want to necessarily preserve the privacy of your different users. So I think that's one concern that especially in an open system like we've seen with Bitcoin, where, even with privacy preserving features like the Wasabi wallet, which is meant to protect a little bit more of the identities behind it, we saw that was cracked, right? And so I think there's a lot of concerns around people want a level of privacy. I think it's a fair ask. It's, personally speaking, I think fundamentally it's the right of every person to have a bit of privacy to do with their financial health, their private lives, whatever it may be. When we apply that to our financial system, I think that's where you have firms like Circle and USDC bringing in a new level of transparency for dollar-based payments, or the euro case, perhaps euro-based payments. I think there's a valid concern with respect to, well, what's being done with this data, right? And so even when we look at, shifting away potentially from a cash-based society to full cashless, there's a lot of considerations that have to be taken into place. We have to figure out, how to integrate with current systems. We have to look at how the private sector are able to integrate with this. I think we also have to look at what's the level of the banks in terms of their integrations. Mark Carney, formerly of the Bank of England, has spoken out heavily in favor of central bank digital currencies. But, the banking system is much more integrated in the UK compared to something like the States, for example, where many of the larger banks have a lot more financial sway and would be wary to give up control of that to the central bank. And then we have ones, Vesto being based in Bermuda, for example, where there is no central bank. And that's a whole new world of saying, okay, well, what if we were to take the private sector innovations, apply it on a larger scale to applying these things, as you mentioned, like paying taxes. Bermuda allows you to pay your tax payments in USDC, in Circle-based dollar stablecoin. Dollar-based Circle stablecoin. And so I think part of this comes back again to understanding, again, people are now waking up, I think, a little bit to the impact of inflation and not recognizing that, is it just this bogeyman that I have to hear about? I just need to make sure my paycheck kind of beats like 2 to 3%. And now we're talking 8-9%, and we're talking potentially double digits inflation. These are the sorts of things where you would historically only hear it about, in the past we've had, Venezuela, about people talking about Zimbabwe and talking about these million, trillion, billion-dollar notes.
And now we're talking Germany. Now we're talking U.S. countries where people got nervous when inflation was above 3%. Huh?
Exactly, and now we're it's Germany obviously was the Reichsmark, I think, was the one whichever was the currency back in the early 20th century that was hyper inflated away, so people were using this to burn cash. And so
good old Reichsmark, yes, exactly. Yeah. Mm-hmm.
Yeah, and so now we're looking at this from a perspective of, okay, how do I protect? It doesn't matter what the dollar amount in your bank account is if your purchasing power has been completely removed. And so that's, I think, the piece that nowadays we're beginning to find a little bit of, if this is going to be the situation going forward, how can people protect themselves, both from a privacy perspective and from a purchasing power perspective? And I think that's likely where we'll now see, both from the financial institutions and from larger groups like maybe pension funds and governments, will now look at Bitcoin as a potential hedge against the actions of central banks. And that's, I think, where this kind of all comes together, is that we've seen you can't just build something and put lipstick on a pig. It has to be true innovation. We have to have an open, transparent market for yields, and you have to preserve privacy. And that's kind of where we're now hitting this tornado right in the middle.
And that's where I wanted to come. Tornado really was kind of like my final story, because I think we've answered the Klarna issue. Klarna, not surprising, big growth because it was easily scalable. It was nothing really new. It looked nice, so people accepted it. But in the long run, one has to say, hey, are you protecting me against general concerns, inflation, privacy, efficiency of classic financial markets? We have to say no. We simply don't. So unless there's any serious back and systemic innovation, we'll not be seeing any kind of sustainable business success. So I think we've answered the Klarna story, leaving us with Tornado. Obviously, Tornado was interesting. I mean, as far as I remember, Tornado's developers are still anonymous. We still don't know who stands behind Tornado, but they've made a remarkable move last couple of days, because everybody's talking about privacy preserving protocols, and now they said, hey, we need to increase transparency. So what, we become fully open sourced. Period. I mean, they've already made their protocol somewhat transparent. It was analyzable, so to say, but now with making that whole code open sourced and providing it to others, I mean, they've probably entered a whole new round of transparency and ensuring, privacy to especially institutional users. Sean, what's that going to do to the market?
Yeah, so I think and maybe for some listeners that aren't keeping a close eye, Tornado Cash essentially is a way that, based on Ethereum, you're able to move funds in. It will mix the funds up with other users that are sending transactions at the same time, and will then provide back.
They're a huge, gigantic crypto blender, huh?
That's a good way of thinking about it, right? And so you can put in essentially, I send in 10 Ether into Tornado Cash, and I will receive back 10 Ether, more or less, minus, I think, a little bit in fees. But as part of that, there's now no link between this crypto and the previous crypto that was sent in, right? So if I, for example, were to specify, I have two wallets, one of them holds 10 Ether and the other one is brand new. I've spun up. There's no link to any other identity. There's no transactions in or out. It's just a fresh wallet. If I send the Ether into Tornado Cash mixes up with other transactions at the same time and receive back the amount that I put in. That amount now has no trace other than coming from Tornado Cash. As of today, there's been no break in the cryptography used that allows for this to be mixed up. So I think part of this is to say that Tornado Cash is a way that provides anonymity and privacy in a world that is very transparent. Now, part of where this gets interesting is that people are concerned that there might be bad actors using this, right? And so we've seen, for example, some of the money that has gone through this, some of the money that is locked up in Tornado Cash is known from hacks, right? It's a well-known place where, upon there being a new DeFi hack, people will use Tornado Cash to essentially launder money, right? The thing is that Tornado Cash, the vast majority of transactions, as per what we've seen so far, tend to not be well-published hacks. It tends to be people that are just interested in privacy-preserving features. That's where I think there's a little bit of a poor reputation for mixers and the like. And part of the idea of what could be a benefit to society is that, what if you were able to integrate this into the crypto, right? And so I think this is where things like privacy-preserving cryptos like Monero are trying to push forward, is the idea that we're able to have an open, transparent, verifiable transactions, but without it being tied back in an identifiable way. What this all brings us into this now is, as I think we're going to see much more of the shift towards the central bank digital currencies being rolled out by governments around the world, and as people begin to get a little less comfortable with governments having full insight into their financial transactions, as well as having insight into their daily lives, now we hit a little bit of a tipping point where I think more of these mixers are going to spring up. I think this opening up of the open source code is in fact going to be a very interesting space in terms of what happens here, right? And so they open source the UI code, so maybe they're not going to give away all the secrets here. But I think part of it is that this open, transparent ecosystem has the need for there to be privacy involved, right? And so all of this then comes with, as you have institutions then moving in, as we've seen, for example, with some of the EU regulations more recently saying that there must be KYC for wallets over X amount. We work with different firms that have done different identity provisions in the past that are trying to say, okay, how do we allow for there to be compliance while still not giving away everyone's secrets? And that's the delicate balance that I think is going to need to be walked in the coming years. With Tornado Cash and others like it, I think it's only the beginning for seeing a lot more of a privacy push. I think Monero and other privacy-preserving cryptos amongst these mixers are going to see a surge in the coming weeks, months, years, as the impact and the potential impact settles into people's minds of, what if everything was open source? What if everything was out there in the world? Well, maybe there's things I don't want people to know, and it could be
right.
It could be completely fair things, right? For example, let's say I get a raise. I don't want my landlord to know this because they might increase my rent now. It shouldn't be that your bank balance is available and visible to anyone that you make a transaction with at your local coffee shop. Things like this, right? I think there's an expectation of privacy, And it's possible in a world that still has transparency across the financial system. So,
and I think, and I think that's an interesting whiplash effect, you know, because in the past, you know, a lot of people have used Bitcoin, for example, you know, to have super privacy, you know, which is why a couple of years ago, 80% of all Bitcoin transactions were dark web transactions, which is not true anymore, you know. But now it's kind of like the whip has swung to the other side, you know, where people are getting increasingly concerned about what's the level of privacy in protocols, you know, which essentially are a black box to me. You know, it's like I put information in there, I do transaction in there using a protocol, but I don't really know what's happening and how the transaction is being administered with all the corresponding, you know, information flow based on that.
and I think really it comes back again to what is the main goal here? Why does crypto resonate with so many people? Why is this beginning to pick up steam? I think it's because people want a level playing field. And I think that's where we're now getting to, where it's a point of the traditional financial system left a lot of people out of access to these things like just appropriate levels of yield, being able to beat out inflation, ensuring that you're actually able to have access to these products. What crypto has now done is saying that, you know, if we look at something like Ethereum, for example, when, you know, touch wood, fingers crossed, they shifted to proof of stake in the coming months or year, you know, the base level of issuance is the same for everyone, regardless whether you're staking, you know, the minimum amount that you can, or you're staking hundreds of millions of dollars of Ether. A percentage that you receive in terms of what you've put in, how much you're getting above that, will be the same. And I think that's where, you know, whatever that amount ends up being, that's where now we've recognized that what if we built a system where the base level is the same for all? And I think that's where now it begins to equalize this between what's the yield that's being generated versus what are the opportunity costs. And the more transparency we have in the market, the better priced out everything will be. And of course, the better that, you know, people are more able to take the right level of risk for them. So with firms like Vesto, right, like, you know, when we're trying to bring in, you know, these institutions into the space, that's where I think it has to be, you know, brought and say, some of you will be more comfortable with potentially higher risk investments. Some of you want something exceptionally stable, and some of you want a mix. And I think that's where we're now getting to this level of customization, which is possible.
Of customization and of companies like Vesto providing the rails, providing the infrastructures where the institutional players can then put their individual use cases, may it be higher risk, lower risk, medium risk, or whatever it might be remittance, wherever those institutional players can put their use cases on top. However, the basic requirement for that is trust of institutions, trust of investors into the crypto system, trust that has been destroyed a bit by the defaulting players, you know, like Celsius, you know, putting up Ponzi schemes, which we're now trying to gain back. And we see Circle's efforts in that regard as well. And then we can really have an inclusive, efficient, and secure crypto-based decentralized financial system, which in the end can even allow people to hedge against inflation of central bank currencies. Is that a fair summary of our talk, Sean?
I think it's a good place to see where things go next week. So
wonderful. Hey, we had a plan, you know, to run shorter this time. We again didn't mention we had too much to talk about. Sean, was a pleasure. I learned a lot again, and I hope, ladies and gentlemen, you enjoyed our weekly ramble on what's going on in the world of crypto. Please stay tuned and watch us again for the next Vesto Show. Sean, thanks so much. Greetings to Montreal, and hope to see you again in our next show for more updates and more discussion points. Thanks so much.
Looking forward to it. See you next week.
Bye-bye.